Hello, everyone. Chris Hamilton here, and I am here with Brian Manko and Jeff Kane from Brian's from Open Mind Accounting, and Jeff is from Kane Law Office. And we will be getting started here in literally about 1 minute. Just waiting for some more people to show up. The premise behind the broadcast or the webinar today is that we are going to have a tax person and a legal person answer questions for you. But each of these guys are going to bring some information to the table and start talking with some talking points. And then if you want, you can text questions. If you're viewing on the landing page, there is a chat box down below. We'll be monitoring that as well. One of the things that I will mention is that if you want to text questions to me, Chris Hamilton, you can text them at 403-630-1243. So if you want, you can write that down and be able to text your questions in or put them into the box down below. And with that said, I think what happens, it's the top of the hour. We will get started with Mr. Brian Manko here. And his presentation. So take it away, Brian. You can introduce yourself and tell them a little bit about who you are and what you do.
Thanks very much, Chris. Well, I'm an accountant. I focus in tax. I'm in public practice. So I do largely corporate returns. Let's see, I've been in it since 2010. I'm a CPA. I teach for the CPA. I've even written some curriculum for the CPA as well. So I'm reasonably involved with them. Anyways, what I really enjoy customer service and helping people get through some of the tax hell that we all face at the end of each year. So primarily our goal here today is to talk about the difference between sole proprietors and corporations and the advantages of having a corporation. And I'm going to leave a lot of that to Jeff, but I can definitely talk to some specific advantages. What I thought I would do just prior to that is talk about some general tips for people, because realtors, have some very specific needs in the world of tax. One of them is vehicle expenses. So this is kind of just preamble before we get into the meat of the matter, but everyone needs a vehicle to get around. The way CRA looks at it is what percentage of your vehicle use is used for business. So if you keep all of your expenses, keep a very accurate record of the actual receipts, not credit cards and bank statements, it has to be receipts. You take a ratio of how many kilometers were driven and how much was used for business use, and that's how you arrive at your number. So it's important to do that. We want to reduce tax in any way we can. Another really good way to do it, if you are incorporated already, is to charge the use of your vehicle to your company. So if you own your vehicle personally and you use it for your company, the first 5,000 kilometers, you can invoice your company for 54 cents per kilometer for the first 5,000. Second, after that, it's 48 cents per kilometer for all of the rest. So it's a great way to get money out of your company tax-free into your own pocket. You just invoice your company. Chris Hamilton last time we did this, came up with a great thing that I've been using. It's called TripLog. So it's an app called TripLog. It actually sends me a weekly spreadsheet of where I've been. All I have to do at that point is just kind of sort out which was personal and which wasn't, and it's an incredible tool. CRA will, CRA would have a hard time with that one. So what do we have next here? Section 85 rollovers. This is a question that came up in our last webinar when I mentioned it. Realtors are investors. There's a lot of realtors who have properties. What do they do with them? And what do we do once we do incorporate? If you're a sole proprietor, or if you're someone who had a handful of properties before you get into real estate and then you incorporate, well, how do what if you want to move your properties into it? Well, Jeff would be, someone really to specialize in this. When I do Section 85 rollovers, I do go to a lawyer to get them to assist with it. It's part of the tax law, Section 85, Section 86, tax code. There's a procedure where you can move something personally owned into something corporate owned without it being a deemed disposition. So you can do it without any tax implications. Has to be done exactly right, but it can be done. So that's just another tip, something to keep in mind for those of you who have a revenue property or something that you want to move into this corporation that you're about to form. Next, we have gift cards. We had some debate about this last time. Gift cards are a great thing for realtors to do, and lawyers, I should do that as well as an accountant. When if you close a deal with someone, wouldn't it be nice to give them $100 in the form of a gift card? But what is the tax treatment of that? And that was the question that came up last time. So the way it works, you can gift, you can buy a gift card from. The information I was going over this morning, if you buy a gift card from a restaurant, that gift card unfortunately still only goes as far as meals and entertainment. So you can only write off 50% of that based on what I was reading this morning. If you buy a gift card, say from Home Depot, that one you can write off 100% because it's not meals and entertainment. So those are the two things on gift cards. In terms of reasonable amounts of doing this, what CRA is watching for, they don't want to have people who make, say, $100,000 a year go out and buy $20,000 worth of gift cards and try and write that off, because that would not be considered reasonable. That would be considered way too much. Especially some of the abuses with gift cards are that people might buy the $20,000 of gift cards and use it entirely with themselves or their family or friends, using it as a write-off, not paying tax on the $20,000 and not even giving the gift cards away. So that's one of the abuses out there, and that's why CRA pays attention to it. But if everything's done reasonably, then and you keep your receipts for buying your gift cards, you shouldn't have any problems. Next, we get into.
We're going to talk about bookkeeping if you want.
Yeah, no, bookkeeping is something that's going to be very, very important to all realtors. I just went through a situation with a client where they tried doing their own bookkeeping, but they didn't really do a very good job of it. And without any intention at all, they sheltered way too much income in a short period of time. And I can get into the technical reasons behind it, but they overestimated their expenses because of the way they improperly recorded some things, and it was a material amount. CRA would have been very upset about it. So it's important to have good bookkeeping services, and Chris has a great bookkeeping company that I'll let him embellish on before. But I do have a referral for Chris that I got yesterday that I'm really looking forward to doing more work with. Chris's service has been great. So. Do you want to tie into that?
Sure, I'll just talk to the importance of bookkeeping. So just on the importance on bookkeeping, really what happens is throughout the year, you're filling up with gas, you're going out, taking clients out for meals, you're doing a whole bunch of different things. And the unfortunate part is at the end of the year, you walk in the door to your accountant and you drop off a stack of receipts, invoices, bank statements, credit card statements. And quite honestly, by doing something like that, what you're doing is you're rushing your taxes at the end of the year. So if you actually were to manage your bookkeeping throughout the year, or do bookkeeping throughout the year, what you're going to end up finding is that you're going to have a better control on your finances. You're going to be able to see where your money's going. You're going to be able to budget better, and on top of it, you are going to be able to really just get the full out view of your financials as it relates to what you're doing as a realtor. So my recommendation is that you should look at bookkeeping. It's something that I do handle. If you need to get a hold of me, you can call Chris Hamilton at 403-630-1243. I can talk to you a little bit about that. I also have a bunch of bookkeepers that we can help you out with on that side of things. But it doesn't take very long to do this sort of thing. In fact, I have a package that allows you to take pictures of invoices and receipts, and basically it will automate a lot of your bookkeeping for you. So one of the things we got a question here from Ray C. And Brian, I think this is for you. So I'm done with the bookkeeping. Hold on, Ray, we're going to answer your question here. It says, if you switch a revenue investment property from a personal account to a corporate account, don't you have to declare the value on the date you change the account and pay the capital gains tax based on that date you change? Does that make sense?
Okay, so the question was, if you move something from personal into corporate?
If you move a revenue investment property from a personal account to a corporate account, don't you have to declare value on that date? You change the account and pay the capital gains tax based on the day that you change.
Yep, that's brilliant. That's exactly right. But there's a provision to do it tax-free. If you use the Section 85 rollover, it's like waving a magic tax wand that allows you to move it in without triggering a capital gain or deemed disposition.
So in that case, Ray, you should probably contact Brian directly, and we've got his phone number and contact information at the end of the webinar here as well, and he can talk to you further about that.
Sure.
Or is it something you could discuss even right now, just kind of how it works?
I could discuss it very briefly, because from my experience, I used a tax lawyer to do that, and it's what it is a series of forms, applications to CRA. You have to, subsequent to that, you have to record all this properly on your T2 tax return and T1 as well. And it's a lot of paperwork, both in terms of the corporate tax lawyer and the accountant as well. It's not cheap to do, but you pay a heck of a lot less in fees than you do in capital gains tax. So it's to summarize it, it's a lot of paperwork. Once the paperwork is done, then everything is in place.
That's where someone like you can come along and help with this.
Yep.
Excellent. That sounds good. Well, I'm done with the bookkeeping side. So now you want to talk about incorporation versus sole proprietorship.
Yeah, and this is where I'm going to try not to step on Jeff's toes here at all. Just to kind of maybe more by way of introduction, when we talk about the relative tax rates between corporations and sole proprietors, if you can incorporate, and if you are a CCPC, and if you get the small business deduction, you're paying 10.5% federal tax and 2% provincial tax. So that's incredible. I mean, the difference there. But we know how high how high our taxes are on the personal side. They can go as high as, say, 41%, whatever it is, depending on the tax bracket that you're in. The side-by-side comparisons between just federal tax, corporate tax versus personal is staggering. Like when you get up to, say, 200,000 a year, you're paying in the range of 40% tax personally. And why do that when you can pay, say, 10.5 federally and 2% corporately, provincially? So that it's in itself is a no-brainer. The other one that's a no-brainer is the ability to have some liability protection. The assets that you have in your corporation, well, they can't sue you personally, they sue the corporation. Of course, that can be offset if you have zillions of dollars inside your corporation, but there is that protection as well. Another one is that when you go to your accountant at the end of the year, you've gone through Chris for bookkeeping. What you find once you put everything into the tax software is that when there are a number of limits on some of the write-offs. Like, for example, on the personal side, you might be able to, you might have $10,000 worth of expenses in a certain area, but oh geez, it's, there's a limit on the amount that you actually can write off because of tax rules on the personal side. Whereas on the corporate side, there are not those kinds of limits. If you had $10,000 of vehicle expenses, you get $10,000 of vehicle expenses. So you can write it down directly proportionately to the amount that you actually have spent. So there's that advantage as well. So right up to 500,000 before the small business deduction doesn't apply anymore. You can pay so much less tax on the corporate side. So those are the two main ones. And maybe with that, I can turn it over to Jeff.
Hi, everybody. Jeff Kahane from Kahane Law Office. Happy to be here. You may know me from such things as real estate transactions. However, today, because we deal with so much real estate related work, we end up dealing with a lot of corporate stuff. And we have a whole corporate team here. And there's a lot of good reasons why people should incorporate. I just wanted to first touch on the idea of sole proprietor. People hear that and they're like, what does that mean? What does that mean? Being a sole proprietor just means that you are doing things on your own. You're signing contracts with people, you're earning income personally, you're earning funds and doing everything directly with you as a person. So you pay your taxes, as you heard, as you as a person, and you have liability as yourself as a person, meaning someone will sue you if they're at a loss. And if you're not insured enough, or if your insurance doesn't cover it, or if it's something related not to that REIX would cover, then your personal assets are at risk, including your home. Whereas if you incorporate, you then have another legal entity that is dealing with everything for you. So a corporation as a legal entity means that it has its own status. A corporation can own property, corporation can go to court, and everything is done through the corporation. So if you are paying taxes, as you should, you're going to pay them under the corporate rate. And we heard the percentages in terms of differences. Just to give an idea of what those numbers mean, I was just doing some quick calculations as we sat here. So if you're earning about $100,000 a year, it's about $23,000 difference in taxes. $150,000, about $40-something thousand dollars. $200,000, $80-something thousand. It's significant. It's worth making those difference just to keep the money in your jeans. The other side is the liability side. Liability, and I am not forwarding the slides. Liability purposes, if your company signs a contract to help someone buy or sell a house, and there's any kind of problems that you run into that you have personal liability for, then it's the corporate entity that gets sued. And a person can't pierce the corporate veil, which is a fancy way of saying they can't go around the corporation unless you've done something like fraud or something like some kind of gross intentional misconduct to go at your personal assets. So if you have revenue properties and you hold them in one corporation owned by you personally, and you run your real estate business out of another corporation that you own personally, the two corporations are completely separate. Their assets are completely separate. Your normal payment to yourself for the services you provide to your corporation are legitimate, and they can't go through the veil. Now, if you're in the process of being sued and you liquidate everything to get rid of someone's potential out of your corporation, then we can have some ability to go back after you. But as a general rule, it's a great way to protect yourself from liability. And if you have any questions, obviously you can give me a call anytime. But those are the two main and significant reasons why you would want to incorporate. And the cost isn't a lot. The cost of incorporating is relatively low to the benefits you get. And we can talk about that as if you give me a call. We just have flat rates for that. Easy to set up, and we can do it fairly quickly. Why a lawyer? So some people go straight to a corporate registry and they'll just get the corporation, and then they years later pay us or their accountants or both to fix the problems. One, in terms of why going to a lawyer and getting actual corporate advice, is your corporate structure. So this is going to be what kinds of shares and the number of classes of shares you have. And having a corporation can allow you to income split with a spouse. So you're issuing either money as someone who's doing work, or sometimes better, issuing dividends. And maybe you want other people to, you'd want your spouse to earn a dividend separate from you. So we will look at what your situation is and how to best set up that your corporation. We always work with your accountants, so it's not like one or the other. We work together as a team. Your accountant will take care of all your financing day to day in terms of your specific financial situation. They will know that and have some knowledge of it, so that we work together to set up your corporate structure. Then we're going to have restrictions on shares. And there's a few reasons why you want to have restrictions on shares, mostly to do with taxes ultimately. But there are restrictions that if you were to just go to a registry, they would not, their normal rule is not to put restrictions on the shares at all. And we need to make sure that you're protected so that you meet all the requirements necessary in order to get all the benefits for tax. And even down the road, if you end up selling your real estate business, having some protection in terms of capital gains, because there is a one-time personal exemption from capital gains that you may be able to take advantage of. Next is your minute books. Minute books are so important because you can't point to a corporation. You can't point to something and saying, here, take the pulse of this. Let's see if it's healthy, if everything's in shape, if everything's good. There's no physical entity like a person that you can determine if it's okay. A minute book is the log of your corporation that shows everything that is required to. So it's going to show who has signing authority. It's going to show if all the returns were done regularly on a regular basis. It's going to show if what the rules are in terms of the corporation, what it can and can't do. And if it's not properly maintained or drafted, you could lose your ability to do things. One, sell the business. And we've had people who've had to spend tens of thousands of dollars to fix things after. Two, financing. If you own any kind of properties with a corporation and you need bank financing, they're going to need your minute book. If you're selling anything, you're going to need the minute book. And if it's not up to date and current, it's going to be a problem in terms of getting what end result you want to get done, because no one can say this company has the right to be able to do that. So that's going to be another key one. There are kits, and that's the fourth point here. A lot of kits, people will go to the internet because it knows everything, and my friend Google is all-seeing, all-knowing. And the problem with the kits is, a few of them, is one, is they're not always made for Alberta law. Two, even if they are, they're not always up to date because the laws do change. And this is true of almost all legal kits, whether it's wills or incorporations or minute book kits. And three, they're not structured for you because there are small differences in people's situations that can make a huge difference in terms of taxes, liability. And that's just assuming if they're done correctly in the first place. Even if it is the perfect kit for the perfect situation, they're often just not even signed off on and done properly. Going to also touch on registered office. Once you're incorporated, there's things you're going to have to do on an annual basis. And there are also provisions, much like an address on title to property, where if you're being sued, and there's the first one here, if you're being sued for something and you're on vacation for 2 weeks, good service is serving the registered office of a corporation, of a business. And if your home, if you have your home as your registered office, gets served in registered mail and you are not there for 2 weeks, then you could be noted in default before you even find out that you've been sued. And we deal with this all the time. We probably 4 or 5 in the last month and a half where people were sued, had no idea they were sued, had a judgment against them, had enforcement procedures started against them, and they didn't know. And in those cases, sometimes it's that they have their home address and they were gone or don't pay attention to their mail that comes in on a regular basis. Other times they move and forget to update things. So it's so important to keep that up to date. If you're using a law firm as your registered office, again, it's a low annual fee. It's not very much. Then you've got, if anything is served, the lawyers get it. We can deal with it. Even if you're out of town for 2 weeks, we can ask for extensions. We can make sure everything doesn't get out of hand. Next thing is just the annual registrations, annual returns. We want to make sure that the province gets your annual notices back and make sure that your company still maintains its status. Because if you lose your status because you haven't filed your annual returns, then and not tax returns, these are with the corporate registry, then your corporation can be struck and you could lose your tax protection, you can lose your liability protection, you can lose everything that you've worked for towards setting up the corporation. And then again, just maintaining those corporate minute books. It's so important for those to be up to date so that if you are doing anything down the road, you have the ability to do that without the hassle of trying to fix everything after the fact, assuming that it hasn't been struck, there haven't been bigger problems altogether. So those are my points on that one.
Excellent. So we're probably into some questions. We got a couple of questions. So Ray just give me a sec, Ray. I've got to find your questions because they were good ones. The first one is from Ray. So if you make, and I think this is probably directed to Brian, it says, so if you make $100,000 a year and you pay a corporate tax rate on that amount, if you need the rest of the money to live on, what amount of tax do you pay when you pay yourself the rest of the amount?
Well, it depends. If you want to take the rest out, maybe you don't have to take the rest out. But if there is some average amount between the 12.5% and what you have to pay on the rest, I mean, it's going to be lower than if you took it all out at personal rate. But greater than 45,000 to 90,000, the personal rate is 20.5%, and so that's if you're just taking it out as a wage. So income, that's T4. What you do is you get your accountant to issue a T4. You can actually do it yourself as well. And if you pick $45,000, let's say, then it'll be 10% tax provincially and 20.5% federally. So on a small amount, you'd just be paying 30% tax on it. Under that amount is 15% federally and 10% provincially. So it's really a small amount of personal tax that you take out. It's where you really get the advantage from incorporating is when you're making, say $150,000 a year and only paying 12.5% on it. That's when you really kick. So another way to do it is with dividends. Then you T5 yourself. So if you're going to bonus or wage, that's T4. If you're going to have a dividend, that's T5. So that's a matter of keystrokes as well in the tax software. That goes into CRA that they know that you've got T5 income. and that has a lower rate than the personal tax rates. There's been some changes to that, though. The dividend tax rate has been changed. It's not as advantageous as it used to be, but it's still lower than personal tax. So there are the two options to get your money out of your corporation: T4 it and pay regular personal taxes, or T5 it as a dividend.
Well, the other advantages, like you said before, were vehicle expenses you can take straight out. Literally, you could write restaurant expenses off, a whole bunch of different expenses. So you're using the corporation to pay for food, driving, all the other stuff, right? So that's where those benefits come into play as well. So.
Oh, and there's some income splitting as well that you can do. I mean, you can T4 your wife. You can hire her as, I don't know, whatever. I do have a client who does this. She is his bookkeeper. So he makes around, say, the 120 range, and he takes out 40 for himself and 40 for her. She does the bookkeeping, and there you go. So they 12.5% on the first 120,000. But now you do take out, mind you, that when you do T4 something, that's a tax write-off. So now, if you made 120 and took out 100 in wages, you're only paying corporate tax on 20,000. The remainder, the 50,000 and 50,000, you would pay personal tax on that. So in here it says, over 45,000, the money that you'd be taking into your personal accounts, you'd pay 20% federally and 10% provincially.
The other question, Ray had another question. He's full of questions. Thanks, Ray. The other one was, what is the cost for corporate income tax preparation?
Well, there's a difference there as well, because there's a different standard. There's a very high standard for corporate tax accounting. Even at the introductory level, which is notice to reader, beyond that, there's review engagement. Beyond that, there's audit. And audits end up being 20,000. Review engagements become 8,000. But not to confuse the situation by throwing those numbers out, notice to reader generally start at around $1,500, and they go to about $1,800, because there is a lot of proving up that you have to do. And CRA requires that because if you get such a favorable tax rate, they really want to make sure that your accounting is good, and they are able to know what really came in terms of income and expenses. That compares to sole proprietor tax returns, and those always go from, say, $350 up to $500, because there is a lower standard there. But they're often, it's kind of funny, I was debating this the other day, they're often about the same amount of work. But I would just say, the $1,500 that you'd have to pay, that is a write-off as well. So you get to shelter $1,500 worth of income on that. So it's more, but the advantages far outweigh. Like Jeff was saying about the cost of incorporation. If it costs you whatever flat rate we imagine to do that, think of how much tax dollars you'll save. You pay to incorporate, you pay your flat rate once, and you've got the tax advantages forever. Now your corporate tax, if it's $1,500 per year, you're still way further ahead by paying, $23,000 less in tax per year. $1,500 pales in comparison to that. So that's the way to look at it. And I don't know if that answers the question or not.
I don't know, Ray, you'll have to let us know. Jeff, I have a question for you. Is how long does it take for someone to get incorporated? If they come in the door and start talking to you, how long is it going to take for them to get incorporated?
Sure. Well, incorporation, we like to leave 3-4 days or a week, but literally if we needed to get something done for the next business day, we could. We've even had people who needed it today. And it's a rush, but we can get it done. And, in terms of flat rates, depending if you want a numbered company or a named company, you're looking at, under $1,500 for sure. I think it's about $1,200, $1,300 for a named company, and maybe $1,000, $1,100 for a numbered company. And the difference is just the review, doing a nuance search to make sure no one else is using that name that you want. It's a requirement, and going through making sure that it's going to be okay and you're not going to have fights down the road with stealing somebody else's name. And certainly in the real estate business, we have seen some fights over trademarks and the names that people use.
So is there any advantage to using a numbered company over like a named company?
Yeah, there is no difference between a named company and a numbered company. From a legal standpoint, they are the exact same thing. Most people like a named company just because they can say, I'm the best business LTD, or the silly little corporation. You can name whatever you want. A numbered company is just going to be a 1, 2, 3, 4, 5 Alberta LTD, or 1, 2, 3, 4, 5 Alberta Corp, or what have you. And it's legally there is no difference at all. It's just a matter of preference, and especially if you have a few corporations. If you have rental properties in one, if you're flipping houses in another, and you have a real estate business in a third, then you can label them and not get confused between which one's which all the time, which can happen, and you don't want to take money from one by mistake instead of the other. So you can name them John Smith Investment Property Ltd, or Jake's Real Estate Company, or Betty's Flipping Houses Emporium Corporation, whatever you want.
Okay. Another question for you, Jeff, is I often see realtors work as a team. Now, oftentimes there's spouses that are involved with team members and stuff like that. How would they protect themselves or protect their business partner if something should go sideways in a marriage or something like that, so that the one person, the ownership stays with the two people, or what? Like how could someone do that sort of stuff or protect it? A little bit outside of this, but thought we'd throw it in.
Yeah, no problem. So it depends how your corporate structure is set up. If each realtor in a team has their own corporation, then they can decide to do business together as a partnership, which is not a legal entity in the way a corporation is. It's a two people going on an ongoing business. Or they can have a third corporation that they're operating everything out of, and the two shareholders of that company are their shareholders, or owned personally, individually. And what you would need is a unanimous shareholder agreement. And a unanimous shareholder agreement is, to use the family law analogy, is the same as like a prenuptial agreement or a cohabitation agreement. It's an agreement that sets up all the rules for the day-to-day operation of the company. So who's responsible for what, who does what, but also what happens if there's any fight. So how the company is split up. So you're not going to court fighting each other. The rules are set up. Okay, this is how it's being dissolved if we don't agree to keep going. But we also usually put provisions in there that deal with things like divorce. So, if you want to keep your partner in terms of, or the person you're working with in terms of your corporation, but if they have a big divorce fight and the spouse gets those shares, do you want to have the spouses connected in there also? And if the answer is no, then we can certainly word it so that it's dealt with. If one person declares bankruptcy, if a person loses their mental capacity, if there is fraud or criminal proceedings, we can deal with everything where if there's situations that come up that someone else could get access to those shares, we can protect it so that the company has the right to exclude other people, but also has the right to buy back the shares first. And then if it makes most sense, then those shares can then be, it's the dollars. So let them fight about the money if it's going through a divorce, people going through a divorce or bankruptcy, but it lets you deal with things that way so that there's no issue for the company itself. Death is another one. If one of the people passes away, would you want their beneficiary of their estate, whether it's a spouse or kids, to have those shares and take over? Often the case it's not.
Excellent. Great. Thanks. A little bit outside of the, the scope today, but just thought I'd throw it out there just to show. Brian, one of the things that was asked, I think you already answered it, was Ray had asked, what are the corporate tax, this is a different one. This is a different question. When are corporate taxes due?
It all depends on when your year end is. So it's best to pick a year end that's different than December 31. December 31 is everyone else's year end. And you got to, all the sole proprietors, everyone else, we're working stiff. So we got to pay, by the end April 30. I would strongly recommend picking a year end for your company that is different than that, so that things don't get jumbled up in tax season. If you did have, if suddenly you had to get your corporate tax return done, maybe in a hurry because you kind of let it slide a bit, your accountant is going to be absolutely swamped with personal taxes, and it's going to be very difficult for him to do it. So what I would recommend is, pick March 31st, pick June 30, pick October 31. Then from there, to answer the question, once you have a year-end date, you've got 3 months to pay any tax owing, and you've got 6 months to file beyond that. So it's a little more convenient in that way. Another thing that everyone's supposed to do, not everybody does, is make installments based on the amount of tax that was owed from last year. And in many ways, personally, I don't love it because I just don't like paying the government monthly, but we're supposed to. And so it does have a big advantage. If you have been paying all along, let's say $1,000 a month for sake of argument, If you are getting a little late on your deadline and you haven't gotten your stuff together, or too many things have come along to confound your situation, you can't get your information to your accountant, it doesn't matter because you've been paying. So you don't have to worry about the 3-month deadline to figure out how much you owe and pay it. It's already been being paid along the way. It's a significant convenience from that standpoint. Then you've got your the remaining 3 months. You get a total of 6 months.
This is Jeff here, and I would also add to that because having been in dealing with real estate and real estate companies and realtors for a long time, there are often times where we have people who maybe forget to pay their taxes from their commission or put aside some money from commission checks that were coming in. And this is kind of like a forced way of dealing with it. So you're not at the end of the year where it's like, oh my goodness, where am I supposed to get all this money from? And then we're doing mortgage refinances to pull out equity from homes or whatnot. It kind of forces the ongoing payment so that it's just, you're not shocked with things down the road. Because otherwise, if you're running your own business, it's up to you to submit your taxes. The brokerages aren't doing that. And sometimes people forget.
Yeah. Yeah, it's definitely some really good rainy day planning. Yeah.
So I was asking people on the landing page and also in the YouTube channel. So we've got quite a few people on watching right now, but we'll keep it open for a couple of minutes. What I'm going to do is I'm going to move to the next page here. And Jeff, I'm going to put you first, and Brian, you're last on this one. So the contact info, I put it in the live chat, but just in case. So both Brian and Jeff are in the Calgary area. So I don't know if you've picked up anyone on YouTube that's outside of that, but they're both more than happy to talk to you as well. You can reach Jeff at 403-255-5888. Is that the right number? Yep. Excellent. Or and you see Jeff's email handle down here. I'm not even going to start going through that with either Brian or Jeff, but you can write that information down. Brian, you can get a hold of at 403-993-0518. I think I put an extra zero on the end there.
Zero in the front. It's 5180.
Oh, 5180. Sorry, my apologies. I screwed up on the on how to call him. It's a European number or something now. I don't see any questions coming through here. I will take a look in the YouTube and see what we got going on. So no question there.
I will add that we are, if people are listening from other areas in Alberta, only in Alberta, we can help with incorporating for people across the province. It's not a problem at all. And it really doesn't add time to the process as we can get everything going, no problem. Yeah, so feel free to call. If you're outside of the province, lawyers are registered by their jurisdiction only, so we can't help. Although if you are a BC lawyer, a realtor who's doing work in Alberta and needs to start doing work here, we can do what's called an extra provincial registration, where we allow other corporations to operate in Calgary and have legal status.
Thank you, Jeff. So there again, you've got their contact information on here. Both Brian and Jeff are preferred partners at CIR Realty. So feel free to reach out to them. And I'll tell you, I'm just looking at the tax differences here on the amounts. That's just incredible how much more you can save on taxes. And so I think that's, first things first, talk to Jeff, get some legal advice, and then come to Brian and get the tax advice after the scenes. So
and talk to Chris about bookkeeping.
Yes, exactly. From here, I don't see any other questions on anything. So with that said, we appreciate everyone tuning in and watching. And apart from that, have yourself a great day. Feel free to reach out to either of these gentlemen, and they will help you with any of the questions that you have. Thanks a lot, and have a super day.